Are we looking at a falling knife, a classic value trap, or maybe the biggest tech bargain of the entire year?
That is the million-dollar question.
I mean, that is the exact question we are answering for you today. You are looking at a stock that is just flashing these incredibly aggressive sell signals right now.
Yeah, it's riding a relentless falling trend.
Right. Yet, some of the most rigorous valuation models out there are absolutely screaming that it is massively undervalued. So, before we unpack this paradox, if you are holding this stock or, thinking about jumping in, you're going to want to join the debate.
Absolutely.
So please do us a huge favor, like this video, subscribe to the YouTube channel, and definitely leave your feedback in the comments as we go along. We want to know what you think.
And, just to set the ground rules right up front, because we are dealing with live market data and highly debated valuations today.
Right. It's a deeply polarized sentiment.
Exactly. So this deep dive is strictly an educational analysis of financial data and market psychology. This is absolutely not financial advice.
Yeah, we had to make that clear.
We are just here to help you understand the mechanics of what is happening under the hood, not tell you what to do with your portfolio.
Spot on. So our mission today is to break down the incredibly contradictory situation surrounding Grab Holdings, ticker symbol GRAB, as of April 13th, 2026.
Because right now, looking at Grab is just a bizarre experience.
It really is. Okay, let's unpack this. Think of Grab right now like a marathon runner who just broke a world record, but the crowd is just walking away instead of cheering.
That's actually a great analogy.
Right. Let's start with the financial reality for fiscal year 2025. Because if you just look at the income statement, you would think this company is on top of the world.
Oh, for sure.
They just reported their first full year of net profit. Annual revenue hit basically $3.37 billion.
Which is up 20% year over year, by the way.
Exactly. But here is the number that really jumps off the page for me. Net income swung to a positive $200 million.
That is huge.
It is. That's a massive improvement of over $350 million from the previous year.
It's the inflection point, It's what every technology investor waits for, and
Right.
arguably, it's the hardest transition a company can ever make.
So help me understand the mechanics of that transition. Because for years, the narrative around ride-hailing and delivery apps was that they were just structural cash incinerators.
Oh, absolutely. The narrative was terrible.
The criticism was always that they were just buying their market share by subsidizing our rides and our meals with venture capital money.
Yeah, the old growth at all costs model.
Right.
Yeah.
So what actually changed in the engine room to swing the net income by over $350 million in a single year?
Well, it really comes down to extracting value from a captive ecosystem.
What do you mean by that?
So when you are in the growth phase, you're handing out promo codes, right? You are heavily incentivizing drivers. You are basically operating at a deliberate loss just to destroy the competition.
Which Grab did successfully across Southeast Asia.
Exactly. But what 2025 shows us is that they finally flipped the switch. They reduced those user subsidies. Oh, okay.
They optimized their driver routing algorithms to lower idle time, and they increased their take rate, which is just the percentage of the fare they keep.
Got it. And the user stayed.
That's the crucial part. When they raised prices and cut the promos, the consumers didn't leave. The ecosystem proved to be incredibly sticky.
Which I guess explains the other major metric they reported, adjusted EBITDA reaching $500 million.
Yes, exactly.
For anyone listening who kind of glazes over when they hear accounting acronyms, adjusted EBITDA is essentially the cash the core business operations generate before you factor in all the financial engineering, the taxes, and the depreciation.
It basically tells you if the actual service they provide is making real money.
Right. And a jump from $313 million up to $500 million tells me that the core service is highly profitable. They're even boasting a trailing 12-month earnings per share of 6 cents. I mean, the engine is officially working.
It is working. But a profitable engine doesn't really matter if the chassis falls apart the second you hit a pothole.
That's fair. You have to look at the balance sheet. That is what dictates survival during macroeconomic storms. And Grab has built just a fortress of a balance sheet.
What are the numbers looking like there?
They are sitting on roughly $6.86 billion in cash reserves against only about $1.59 billion in total debt.
Okay, wow. I am looking at that cash pile, and my immediate thought is that in our current, high interest rate environment, having almost $7 billion just sitting there generating yield.
Yeah, it's incredible.
Right. While your debt is relatively tiny. I mean, that is a massive structural advantage. They don't need to go out and borrow expensive money just to keep the lights on.
Precisely. They have completely insulated themselves from the credit markets. And on top of that, their adjusted free cash flow for 2025 was a positive $290 million.
Wait, really?
Yeah, which is almost an 80% increase from the previous year.
That's insane.
So they aren't just magically profitable on an accountant's spreadsheet, right? They are depositing real physical cash into the bank every single quarter.
Okay, so let me get this straight. They have a fortress balance sheet, they are printing cash, and they prove their business model actually works. Logically, you would expect the stock to be just soaring right now.
You would think so, yes.
But if you look at the ticker today, it is doing the exact opposite. Despite a tiny, 1.36% daily bump recently, GrabX is trading at just $3.73.
Yeah, it's brutal.
It is languishing dangerously close to its 52-week low of $3.48, and it is just miles away from its 52-week high of $6.62. I'm honestly struggling to reconcile this.
A lot of people are.
If the fundamentals are this strong and the cash pile is this massive, why is the market treating this stock like it is going bankrupt?
Well, what's fascinating here is that the divergence between the operational fundamentals and the technical stock performance is just extreme right now. If we pull back and look at the technical analysis, the chart is undeniably bearish.
Yeah, I am looking at these charts right now, and it just looks like a total disaster.
It really does. The trend direction is definitively down.
Right. The stock is trapped well below its 50-day moving average, which is sitting around $4.56, and it is even further below its 200-day moving average, which is up near $5.13.
Exact.
To me, that says every time the stock tries to rally and get some breathing room, traders are basically just using that bump as an excuse to cash out, which shoves the price right back down. Am I reading that right, or is this just standard market noise?
No, you are reading it exactly right. When a stock is trading below those major moving averages, it confirms that the broader consensus, at least over the medium to long term, is to sell on any sign of strength.
Got it. So the moving averages basically act as a heavy psychological ceiling.
Exactly. And the momentum indicators confirm this downward pressure, too. The MACD, which stands for Moving Average Convergence Divergence, just a tool traders use to gauge the strength and direction of a trend, is sitting at a negative 0.11.
Which is bearish.
Very bearish. That is a clear mathematical signal that the bears are totally in control.
And what about the RSI?
So the relative strength index is hovering right around 41.81. The RSI operates on a scale of 0 to 100, and anything under 50 implies weakness.
Right.
And it is slowly bleeding downward toward that 30 mark. And 30 is the threshold where technicians finally consider a stock to be technically oversold.
So the momentum is essentially evaporating, and the stock is just pinned against the floor. What are the key battleground levels we should really be watching here?
The technical battlefield is highly defined right now. On the upside, there is heavy resistance at $4.50 and then massive psychological resistance at $5.
And on the downside?
The downside is what has everyone on edge. The critical support zone is exactly where the stock is hovering right now, between $3.48 and $3.60.
Oh, wow. So it's right on the edge.
Yeah. If the macro environment forces the stock to break definitively below that $3.48 floor, technicians will tell you there is very little historical support below it.
It just enters a free fall zone.
Pretty.
But here's where it gets really interesting and where the narrative completely fractures for me. The charts look terrible. The momentum is bleeding out. The moving averages look like a brick ceiling.
Right.
But if we dig into the order flow, the actual data showing who is actually buying and who is selling it contradicts the chart entirely.
It really does.
Over the last 12 months, institutional activity shows a massive buy-side balance. For every $1 institution sold, they bought $3.60 worth of Grab shares.
It is a staggering ratio. It really reveals a massive disconnect in market psychology.
It's like a cruise ship that is taking on water, right? The retail investors are in the lifeboats rowing away frantically because they see the chart sinking.
Yep.
But the institutions, the hedge funds, the mutual funds, the quote-unquote smart money, they are at the bottom of the ship, quietly repairing the hull and buying up all the empty cabins at a 70% discount.
That is exactly what's happening.
Why are the institutions stepping in front of a falling knife?
Because institutions operate on entirely different time horizons than retail traders.
Okay, make that make sense to me.
Well, retail traders are often looking at the immediate downward momentum. They watch their portfolio bleed from $6.62 down to $3.73. They feel the pain, and they cut their losses.
Which is human nature.
Exactly. But institutions aren't day trading the momentum indicators. They are valuing the business itself. When a company with nearly $7 billion in cash and growing profitability drops into what they perceive as a deep discount zone, they do not panic.
They just buy.
They quietly and methodically accumulate shares. They are more than happy to provide the liquidity for retail's panic.
Which brings up the broader consensus on Wall Street. We have retail panic, but institutional accumulation. What do the professional analysts think?
You're going to love this.
I was shocked to see that out of 27 analysts covering Grab, an overwhelming 26 of them rated a buy.
Yeah, that makes the consensus a strong buy.
Right, and their price targets average around $6.34 to $6.47. That implies an incredible 72% upside from where it is sitting today.
And if you move past analyst opinions and look at raw mathematical models, the theoretical valuations go even higher.
Right. I was looking at the DCF models. For anyone unfamiliar, a discounted cash flow model basically tries to figure out what a company is worth today based on all the cash it is expected to generate in the future.
Exactly.
The DCF models for Grab are suggesting an intrinsic value of roughly $11.50 per share. That means mathematically the stock might be 68.4% undervalued at current levels.
Which is an incredible margin of safety, in theory.
But I have to challenge this whole premise. So what does this all mean? We have a stock that looks historically cheap, backed by a mountain of cash, yet the price absolutely refuses to bounce. Is this legitimately the tech bargain of the century, or is this a classic value trap designed to lure in unsuspecting retail traders?
Well, to answer that, if we connect this to the bigger picture, we have to look mechanically at what a value trap actually is.
Okay, break that down for us.
A value trap occurs when a stock appears incredibly cheap based on traditional valuation metrics, like, trading at a massive discount to its DCF model, but the stock price never actually recovers.
It just keeps sinking.
In fact, it continues to drift lower because the market is pricing in systemic risks that the financial model simply cannot capture.
So the model assumes the company exists in a perfect vacuum, but the market knows the real world is, well, messy.
Exactly. A DCF model assumes a smooth, rational continuation of future cash flows. It does not account for fear, geopolitical shocks, or sudden shifts in consumer behavior.
Right.
And this is exactly why retail traders often get trapped here. They buy the undervalued narrative, expecting a quick, violent snapback to that $6.40 analyst's target. But a stock can stay disconnected from its intrinsic value much longer than a retail trader can stay solvent.
Yeah, that's a tough lesson to learn.
It is. If a trader goes in heavily on margin or buys short-term call options hoping for a quick bounce, the slow, agonizing bleed from $3.73 down to $3.48 will just wipe out their account, even if the stock eventually goes to $11 3 years from now.
So if the company's doing everything right internally, the downward pressure has to be coming from the outside. What is the macro drag here? Why is the broader market punishing this stock so severely right now?
This is the foundation of the bear case, and it is entirely macro-driven. The short-term economic outlook right now is incredibly cautious.
Because of what, exactly?
Well, we are looking at oil prices spiking at $111 a barrel. We have escalating, unpredictable tensions in the Middle East. And perhaps most damaging, there are resurfacing fears of stagflation.
Stagflation, being that incredibly toxic economic environment where growth stalls out, but inflation remains stubbornly high.
Yes. And alongside that, interest rates just remain elevated.
But how does that specifically hit a company like Grab? I mean, I understand that high oil prices squeeze the consumer, meaning maybe people order less food delivery or, take fewer rides.
Sure.
And obviously high fuel costs pressure the drivers in their network. But Grab is fundamentally a software and logistics platform.
Right.
Why are they down 37% year to date just because oil is up?
Because of how institutional capital moves during stagflation fears. When the macroeconomic environment looks this toxic, massive funds engage in sector rotation.
Okay, meaning they move their money to safer bets.
Exactly. They systematically reduce their exposure to anything classified as a growth stock or emerging market tech, regardless of how strong an individual company's balance sheet might be. They flee to safe havens.
So Grab is basically being dragged down by a sector-wide software sell house.
Furthermore, the bears point out that Grab operates in emerging markets where localized competition is just fierce. Defending their market share in Southeast Asia requires constant innovation and sometimes really aggressive pricing strategies.
Which eats into profits.
Right. If a macro recession hits those regions hard, Grab's newly minted profit margins could vanish just as quickly as they appeared.
So the worst case scenario for the bears is that these macro factors break that $3.48 support level, leading to a continuation lower.
That is the nightmare scenario for
Mhm.
anyone holding the stock right now.
I hear the bears. The macro environment is undeniably ugly. But I am going to champion the bull case here because the best case recovery scenario is incredibly compelling.
Let's hear it.
We already talked about the record profitability and the high cash to debt ratio. But management isn't just sitting on their hands with that cash. There is a massive $500 million share buyback in play.
Which is a profound statement of confidence from the executive team.
Exactly. I want to break down why buybacks matter because I feel like it is often misunderstood.
Go for it.
Imagine Grab's total value is a pizza cut into 100 slices. The company is basically taking their excess cash, buying back 10 of those slices from the open market, and just throwing them in the trash.
Right.
Now, the whole pizza is only divided into 90 slices. That means the slice you hold in your portfolio inherently represents a larger percentage of the company and mathematically becomes more valuable. Management is looking at the $3.73 share price, realizing the market is severely underpricing them, and aggressively buying their own stock.
It creates artificial scarcity, which provides a layer of fundamental support beneath the stock price, even if the technical charts look weak.
And it doesn't stop with financial engineering. There are major catalysts on the horizon. They have the upcoming acquisition of foodpanda Taiwan.
That's a huge deal.
It is. That isn't just a revenue bump. That is a strategic move to consolidate market dominance. You remove a competitor, and you acquire their entire customer base overnight.
And it allows them to optimize logistics in Taiwan immediately, improving those delivery margins we discussed earlier.
But here is the catalyst that I think changes the entire identity of the company, the upcoming rollout of their autonomous ride pilots.
Yes, this is massive.
If Grab can successfully integrate autonomous vehicles into their network, it fundamentally alters their unit economics. The biggest variable cost in ride-hailing and food delivery is the human being driving the car. If you remove the driver, the margin profile of the company just explodes.
And this is really where synthesizing everything we have unpacked today becomes crucial. We essentially have two wildly conflicting realities operating on two entirely different timelines.
Right, short-term versus long-term.
Exactly. The short-term perspective is dominated by fear. It is clouded by macroeconomic volatility, stagflation anxieties, $111 oil, and deeply negative technical momentum. If your time horizon is the next 3 weeks, you are fighting a massive bearish tide.
But if your time horizon is, say, 3 years.
Then the medium to long-term perspective remains deeply bullish.
Wow.
The core business has never been healthier. They have completed the grueling transition from cash-burning startup to a profitable enterprise. They have an impenetrable balance sheet. And the smartest capital in the room, the institutional giants, are accumulating shares.
Right, at a staggering 3-to-1 ratio against the retail panic.
Exactly. The financial architecture proves the company is structurally sound. The only unknown variable is how long it will take for the broader market sentiment to rotate back and properly value that architecture.
Which leaves us at this incredible crossroads, really. You have retail investors fleeing the technical charts, while institutional investors quietly buy up the fundamentals. And that leads to a fascinating thought experiment that we want to leave you with today.
I love this part.
If institutional giants are quietly buying up shares at a 3-to-1 ratio while the charts scream sell, who is going to be right when those autonomous ride pilots finally hit the streets? I mean, think about it. If Grab successfully rolls out their autonomous fleet, do they even remain a simple ride-hailing app?
Probably not.
Right. With all the proprietary mapping and logistical data they own across Southeast Asia, do they suddenly evolve into the most powerful AI and robotics data monopoly in the region?
It completely redefines how the market will have to value them.
It really does. So what do you think? Are you trading the chart or are you investing in the business? Let us know your thoughts in the comments below. Thank you so much for joining us on this deep dive.
It's been a great discussion.
Definitely. Don't forget to hit that subscribe button, and we will see you on the next deep dive.